Hey, what's up guys? Nehemiah Douglas here. Welcome to the Forex side of Ty's course. I'm super happy that I could be here to share this stuff with you guys because I've been trading Forex for a while now. Been able to accomplish a lot of things in the market, and it's always great to share the Forex side of things with people. Right now, I have currently 700 students all around the world right now, multiple 6- and 7-figure student testimonials, around 24 6-figure and 2 7-figure student testimonials in the Forex market. Basically, quick little rundown on me. I started off just a normal person like everybody else. I'm not like some mathematician or anything like that. I basically just got started because I saw it on Instagram. Just like everybody else, I was just scrolling through, saw a little opportunity on Forex, reached out to the person, they got me started, and the rest is history. So today I'm here to teach you guys basically the fundamentals of my strategy. So today, while I'm here at Ty's, I'm basically going to be going over a lot of the foundation side of things, the fundamentals, and then I'm going to switch over towards the half of this course and basically hop onto my screen, show you guys what's really going on the charts, and then we can really get started with some stuff, and you guys can start applying a lot of this stuff actionably into the market, okay? So, like I said, we're talking about Forex. Just a real quick rundown for those that don't know what Forex is. It's basically the exchange of currency, okay? That's actually what it stands for, foreign exchange. Okay, I'm not going to write that just because I don't want to take up too much white space. But basically, the similarity between stocks and Forex, stocks, we're pretty much trading the equity of a company, where in Forex, since we're trading currency, we're technically trading the equity of an economy. Okay, so, there's a lot of different things that can happen in an economy that help us to make money as Forex traders. Okay, so basically, today I want to talk about, at least while I'm here at Ty's, I want to talk about 4 different things. One, I want to talk about what is the market actually made of? What is the market made of? All right, what is the market made of? This one's important. You guys are probably wondering, what the heck, how does this help me make money? But you guys have to understand the background of things so that you really know what you're up against. Because technically, actually proven, 95% of traders do fail. So you guys, if you don't understand this stuff, you can become another statistic. So first thing that I want to point out on what the market is made of is, one, the market is made up of dealers, okay? Now, I have a quick little story. I basically, I was on a trip to London. I was just, I actually went out there for a conference. And basically, just like everyone else, it's a funny story actually, I was swiping on Tinder. And I was swiping on Tinder and I matched with a girl that she took interest in me because I had put in my bio that I was a trader. I was that guy, okay? So I put into my bio that I was a trader, and basically she reached out to me. She wanted to meet up. We went out for dinner. We went to the Ivy, if you guys have ever heard of it. And we sit down, she starts picking my brain about the trading thing, and I was wondering why she took such a strong interest in the trading stuff. Well, come to find out that she was actually a dealer, okay? Now, I'm not going to reveal what bank she worked for or what institution it was, what her name was, or anything like that for the sake of privacy, but she literally sat there and broke everything down to me, okay? And it was absolutely insane because here's the thing. A dealer is basically what we like to call a market maker. Market maker. All right? These are the people that pretty much, like I said, make the market. They're the ones that are quoting all these price movements that we see when us traders look at a chart, okay? So she was a dealer, and she pretty much broke, and I had no idea about this stuff. I had an idea a slight idea of what market makers were, but at the same time, I had no idea there were other levels of things. I was like, oh yeah, there's market makers. But she broke down that there were 5 more participants in the Forex market. 1, obviously dealers like her. 2, we had sovereign names, okay? These are people like central banks that have tons and tons of capital, Okay, so I could just put CB for central bank. All right, they're market players. At first, when I first thought about it, I thought it was just central banks when I first heard about market makers, but they were actually the second level on the totem pole. Third, we had large speculators. Make sure I'm spelling this right. Large speculators. And these are people like hedge funds. So I'll put HF. I don't have much room. All right? Hedge funds, large speculators, people that have tons and tons of capital, but not as much as the silver names, and they're pretty much playing the market as well. Okay? Fourth, real money traders. Real money traders. Okay? Now, these are people kind of like, mutual fund. I'll put MF. People that manage mutual funds and things of that sort. You invest your money and a mutual fund is going to invest it for you, help you see a small percentage each year. They play the market as well, the Forex market. And then we have commercials. So believe it or not, companies, I'll put businesses, okay, they also play the Forex market. All right, they have all this capital sitting around from their revenues. They play the Forex market as well, and they find returns on the back end of things. Okay, and then the last piece of the totem pole are people like you and I, normal everyday people, retail traders. Okay, retail traders. I'll put you. You guys are starting your career right now. All right, so she broke all this stuff down to me, and it was absolutely fascinating just seeing the contrast between, normal retail trader and having the dealer literally sitting right in front of me, dining with the enemy, telling me exactly what was really going on in the Forex market. Now, the reason why all this is important is because you guys have to understand that the Forex market, or us traders, what we're doing is we're fighting against these people. Okay, they have the capital, they have the power to move the market. We don't. Sure, yeah, even if you're a multimillionaire, chances are you don't have enough money to move the market. All right? So, that brings me into my next point. Got it all stuck up here. Okay? My next point, number 2. How is liquidity created? Created. All right? How is liquidity created? Because if you don't understand how it actually works, and especially once we actually hop onto the charts later, you're going to have a hard time really understanding the strategy, understanding why you aren't making profit on your trades. All right? How is liquidity created? Okay? Now, here's the thing. Those market makers that we just talked about on the last piece of paper, is basically they're making decisions off of our order flow. All right, now to understand order flow, I'll break it down. Order flow. It's just how it sounds. So a lot of you probably like, oh, that makes sense. But order flow is the flow of all of our contracts entering and leaving the market. Okay, so I'll just say our money. All right, they're making decisions off of our order flow. When we place trades, and then they have the ability to see our trades, where we're placing all of our trades, and if there are mass, clusters of traders doing the exact same thing, they will make decisions off of that order flow. All right? This is how liquidity is created. Now, there are 2 different ways to trade the market. One, or I should probably say set trades in the market. One, pending orders. Pending orders. All right? Now to explain pending orders, they're basically, they are a set price, a predetermined price that you would like to get in. So let's say that somebody offers you some money, or offers you something at at $10, okay, at $10. And you say, no, I'd rather get in at 9. Because if I get in at 9, I know that it's gonna go up to 12. It's kind of like Bitcoin. You know, a lot of people are trying to wait for the for the drop so that they can get in and then it jumps, okay, basically. So a pending order is getting in at a better price in the market, all right? Second is a market execution. I'll just put EXE, okay? A market execution. Now, a market execution is just how it sounds. A lot of these terms are very, very simple. I'm trying to break it down simply for you guys. A market execution is going straight to market. You're not waiting for a predetermined price. You're going straight into the market at the set price. So if the market's at 10, you're getting in at 10. And you're gonna hope that it goes up to 11. If you're shorting, you're hoping that it goes up to 9. It goes down to 9. All right, so there's two different ways to set a trade in the market. There's pending orders and then there's market execution. Now, here's the thing. I want to break down these pending orders because this is literally how the liquidity gets created, okay? There are 4 different pending orders. If you guys have ever traded Forex before, you guys may have seen this, okay? There's buy stops. There's buy limits. There's sell stops. And then there's sell limits. Okay? Now, like I said, these are pending orders. So imagine if you knew exactly where $100 million was just chilling, okay? Chilling in the market. So what I want to do, I actually don't have much room. I'll just go ahead and flip the page. Let's say we have a line right here, okay? Some people may say this is support, resistance. You guys may have heard those terms before if you've ever looked into trading, all right? Let's say that this is a support or a resistance, and let's say that the market is right down here, right at this dot, okay? Now let's say that with these pending orders, there's a bunch of traders, a cluster of traders, and collectively, it adds up to $100 million. Okay, 100 million. If you know that all you have to do to get that $100 million and put it in your pocket, walk away, start buying Lamborghinis and stuff, if you know all you have to do is spend 60 million to take that 100 million, then wouldn't you spend it, right? Of course, obviously. So if you spend that 60 mil to get that 100 mil, you're gonna end up with a $40 million profit, all right? This is basically what the pending orders do. The pending orders, they set the marketplace pretty much. It gives the market makers, the dealers, silver names, so on and so forth, it gives them an opportunity to see where the liquidity is, where the money in the market is. So here's what will happen. Market makers, dealers, so on and so forth, they'll show us certain things. So they'll show us these support lines, or they'll show us big impulses, so on and so forth. You know, the market will shoot up. And it causes traders, people like you and I, normal everyday people, to set trades either on buys or on sells, all right? So all these people start entering in on the market. This creates liquidity, and they can see this. So imagine being able to, pull up a chart or pull up a screen, a program, something, and see exactly where the money is. That's exactly what they can do. All right, so let me flip another page and get into number 3. So let's get into number 3. It's gonna be, why do traders fail? All right. We now know that the market's really up against us, okay? That these guys, they're not here to play fair. This is why they stay rich, pretty much. Because the thing is that you guys got to realize is most people do not know what they're doing in this market. A lot of people are misinformed. A lot of people really don't know how to trade successfully. Like I said earlier, 95% of traders fail in their first few months, okay? 95% of traders fail. And knowing this, it's because of the things that they're showing us in the market, all right? They're showing us these certain things in the market on purpose, all right? So that leads me into my first thing on why traders fail. The same information has been passed down for years. Oops, I can't spell. Stomach's growling. Has been passed down. Passed down. All right? The same info has been passed down over and over and over and over again, guys. Like, you know, oh, buy at support, sell at resistance. You know, no one's really teaching how the volume and liquidity even picks up. You know, why these things even happen. There are very few traders that actually know this stuff, okay? So that's one reason why the most traders fail, is they keep listening to all the stuff that they find on Google. You know, most don't even look past the first page of Google. They find these things, they type in how to trade Forex, how to catch this, how to do that, what strategy to use. And they follow all this stuff that has been recycled over and over and over again. You guys got to realize that they're called market makers for a reason. You guys, like, really think about it. Like, where do these markets even come from? Like, really think about it. Where do these markets come from? I sure as heck didn't create them, and I'm sure that you guys didn't. So the thing that you have to really think about is, like, they are creating this. If we see a support line, it's for a reason. If we see a large push upward, it's for a reason, okay? It's all for a reason. It's all designed. So you got to realize that the same info has been passed down. You got to find new information. Second, or actually, that leads me into my next point. I want to give you guys a quick little example. So basically, here's what a technical trader will normally do, okay? And this has been passed down. If you guys have ever traded Forex before, I guarantee you've heard this. Basically, let's draw our support or resistance line again, all right? Now, here's what is taught and has, like, been taught for, I can't even count, like, way longer than I've been trading, all right? Basically, what is shown over and over and over again with technical traders is that when the market breaks past a support or a resistance line, in this case, it will be a resistance line because we're going up towards it, all right? So when the market breaks past a support or resistance line, technical traders will teach you to buy off of the retest. When the market comes back to that resistance right here, okay, that's your entry to buy, and that it's supposed to play out. I can promise you, technical traders, if this is working for you, it's because, and I guarantee most of the people that are watching this, if they are a technical trader, this probably only happens successfully for them like 50, maybe even 60% of the time, okay? I guarantee it. And the times that it did work for you, it's because the liquidity was there to help you out, okay? Their objectives were already met that went along with what you were already trading, okay? So this is shown over and over and over again with technical traders. When the market breaks past a resistance or a support, I'll draw that. When the market breaks past, you buy or sell on the retest. That's what's taught, okay? But in reality, and we're going to be getting into it a lot later on, but I'm going to be breaking it down in a second here. But in reality, this is not the correct setup, okay? It's not the correct setup. It can help. It can help, definitely. But the thing is, it's not the correct setup. Now, the reason why is because the market, hop to my next thing here. Let's see. Okay, the market, like I said earlier, is based off of order flow. All right, the buyers and sellers in the market. Now, excuse me, this leads me into the fourth point. There's a typical weekly structure that happens because of this order flow. typical weekly structure that happens because of this order flow. In this weekly structure, and you'll definitely see me talk about this a lot when I hop onto my screen, is composed of a 3 to 5 level cycle. Okay? This is the diagram that I draw for my students all the time, okay? And it helps them out a lot. It's based off of a 3 to 5 level cycle because you guys have to understand that most people don't know what they're doing, okay? They do not know at all what they're doing, all right? So you got to think about it. If you're an inexperienced trader, if you're just watching this video and you start looking at charts right now, or I think back to the days when I was just getting started with trading, and I'm looking at the market, and I'm looking at a pair or whatever, and I see that the market's going up, right? Like how it is on this side, okay? So let me draw that actually, so we know. This side's going up, and then this side's going down, all right? So I'm looking at the market. None of this has happened yet, okay? So let's draw a line. None of this on the right side has happened yet. So I'm looking at the market. It's been going up for a while. I'm like, dang, like I'm missing money. You know, you're eager, you're excited, you want to get started with trading, you want to start making money, you see people online showing fancy stuff and all that stuff. So you want to get in. But the thing is, they push up once. You're like, oh man, I missed it. You're like, dang. Okay, they push up once. Then they start kind of just chilling around this area. Okay? Then they push up again. And you're like, oh shoot, I missed it again. You're like, man, like, you know, I'm about to subscribe to a signal service or something like that. You know, all the websites I'm looking at, they're saying that it's going up. You're like, all right, if it pushes up one more time, I'm gonna get in. Okay? They start chilling, doing this again. All right? They push up. They push up one more time. And you do what you wanted to do in the first place, right? You want to hop in. Well, the thing is that it's designed to give you this irrational emotion, basically. Because like I said, most people, statistically, do not know what they're doing, and they know that, okay? They know this. Market makers, they definitely know this, okay? So, this cycle is meant to cause a few different things. One, it's meant to cause fear. It's meant to cause greed. And then it's meant to cause hope. This is what the market feeds off of. And as soon as you guys realize that and know that you're not up against, just another normal trader, you're up against a bigger institution, you got to understand that fear, greed, and hope will destroy your accounts in this market, okay? Now, the reason why I say greed, the reason why that's a part of the feeding frenzy is because let's say that you get in at this area down here. You're one of the lucky ones, okay? You're inexperienced, you get in at the perfect time. Let's say that you've got a signal or something, or you looked at it down here going up or whatever reason that you found to take your position here. Well, you're going up, you're making money. What do you start doing when you're inexperienced? You get a false confidence, okay? You're seeing this blue, flashing money on your face, on your phone. You're making money on your phone for the first time in your life, most likely. Or you're trading this high emotion market and you're actually doing well as a beginner. You start packing on your positions. You start doing irrational decisions. Now you've got trades here, 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 all that and above. You take some up here and you're like, oh man, this thing has been going up all week. I'm cashing out. Well, here's the thing. By the time you think that you've got it made, that you're a professional trader, they snatch the market back on you and go the opposite way, okay? And it's designed on purpose. All those trades that you took on the way up, yeah, they were in profit for a while, and you're thinking that they're gonna go up to this level. You're reading Forex newsletters and following signals or following MLM groups, and you're like, oh man, everyone's going up on this thing, okay? And then you realize that they reverse on you, go the opposite way, never to come back, okay? That's why greed is a feeding frenzy for these institutions as well, okay? And then that also kind of plays into that scenario, kind of plays into the hope as well. So, you're hoping that you can really, cash out on this. Or if you do get a trade, you do well on that those first few trades or whatever, you do fine. And then all of a sudden you're like, man, I just lost a bunch of money. Where you're like, oh, well, it's just, they told me it's going to come back up. So the signal service that I'm subscribed to, they said it's going to go back up. So I'm going to go ahead and take another position. I'm hoping that this goes up and I get my money back. They're not going to come back. They're not going to come back at all. So when you start to see the market with a different bird's eye view, you start to really see, especially if you've tried to trade Forex before, and I know probably a lot of people that watch this most likely have, or if not, have at least heard of it. It's kind of blown up in the last 5, 6, maybe even 7 years. So you've maybe heard of it, and you've maybe heard about the lack of success in it, and it's because people do not understand these facts about the market, okay? These 3 to 5 levels, I should put that actually, 3 to 5 levels. You got to understand that it's predetermined, but it's also based off of our order flow, okay? They do these 3 to 5 levels every single time in the market. You'll see them all the time. But you have to understand that it's based off of order flow, okay? Understand that as they push the market up for these levels, okay, what they're doing is they're not only sparking these 3 things, but they're also sparking commitment. Okay? They're sparking commitment. And when I say commitment, you got to understand that at each level, because they can't just push the market one direction for forever. It's just not going to happen. Even when you guys look at Bitcoin, it just can't happen. Like, yeah, everyone's saying that Bitcoin's going to go up, but it has its dips because no market on earth can just push up without pulling back at all, okay? And the reason why is because it'll risk global economies. People start, it just causes a bunch of hoopla, and that's why you would never see it. So basically, they're sparking commitment as they rise for these levels. At each level, they shoot up, they'll show some impulse, then they'll chill out. It gives people time on each level, it gives people time to get in. People, are not only going to be afraid of the market when it's pushing up, but less people get in the market when it's pushing up, okay? So they chill out for a little bit. They'll show us some rise. They're like, oh yeah, we're going up. So people are like, oh shoot, I just missed it. And they're like, all right, it chilled out, so let me get in. Okay, it gives people time, like I said, to get into the market. It calms down, then they'll shoot up again. More and more people get in because they're like, oh shoot, it just shot up for the last 4 days. And when it calms down again, I'm gonna hop in. So they get even more people committed. And then once they get to the top, and they have, their all this level of rise, however many days this took or how many weeks this took, because these levels happen on every single time frame. So if we're looking at a daily chart, for example, this could be over the course of weeks, even months. If we're looking at like hourly, this could be over a course of like 4 days. So when they get to the top, they're going to have a ton of commitment on buys, because everyone who's inexperienced thinks that it's just nonstop rise. So let's say they have that 100 million up here. By the time they get to the top level, they have that 100 million collected in pending orders, because remember, they can see the liquidity. They see which way people are going. And the thing is if they don't have their objectives met, let's say that they look at it and they're like, all right, if we rise this, we want at least 100 mil by the time we're ready to reverse it. If they don't have that, they're going to go for another level. And that's why I say 3 to 5. On the third, if they don't have that 100 mil that they're looking for, and these are just, random numbers, by the way, guys. It's not actually 100 mil. I don't really know what their objectives are each week. But I'm just breaking it down. Like, let's say they only have 20 here, 20 mil. Then here they get maybe another 40 mil. So now they've got 60 million committed. And then here, they have the 100 mil. All right, so now that they have the 100 mil, they want to go ahead and reverse. Like I said, let's say it takes them 60 million to reverse it. They make the market, so, you know, they can reverse it at any time. They spend 60 million, they collect a $40 million profit. Easy, okay? Now, they don't like people like me, okay? They don't like people like me. I'm not a high volume trader. It's not like I'm, you know, snatching 1 million per day in the market. But I'm a market executor. I very, very rarely will set pending orders because I actually understand how they work. I understand that the more I add to the problem, the more they're going to use that order flow to make decisions against me as a trader. I'm not a 100% trader just because I understand this. I'm still trying to find my way in the market as well. And even though I understand their behavior and it brings more success my way, it's that I really don't know what the order flow is saying. If they have 80 million here and their objective is 100, they might throw a wick up or throw up for another level that I wasn't expecting, even though they've had all this ton of rise, okay? So it's really important to understand that if the objectives aren't met, then they're gonna show whatever they can to get that commitment.